Today is designed to offer three perspectives on the investment markets from three very different but very qualified investment managers. Mary Talbot will begin and will discuss the credit markets and her view on the impact of the Fed and central bank actions. David Gong will speak about what he's seeing on the ground in China and other emerging markets, which have an ever-growing impact on U.S. and other developed market economies. Finally, Brad will discuss his strategy and approach for generating positive returns in volatile markets and explain what the risks that are associated with this particular strategy. Market observers and analysts often call fixed income the smart money and consider the debt markets to be a leading indicator as to the health of the economy. In times of financial stress, the debt markets can often act as the canary in the coal mine to spot trouble ahead. This was clearly the case in 2008 as mortgage-backed securities became illiquid, spreads for high-yield bonds widened precipitously before the market sell-off and before Lehman Brothers and Bear Stearns went belly up. Opinions from prominent bond fund managers such as Bill Gross, Jeff Gundlach can be heard on the Wall Street Journal, Bloomberg, CNBC, or Fox Business frequently as they offer their opinions over Fed policy, which are sought out by reporters. The Great Recession of 2008 taught us that a careful and close scrutiny of the fixed income market is not only important, but it's mandatory if you're managing money in equities and fixed income. Earlier this year, I was referred to Mary Talbot, who was in the process of a career change and was considering, amongst many other things, opening her own fund. Given her credentials, which include managing the First Vanguard Bond Fund, managing Mellon Bank's institutional bond portfolio, and then finally as the fixed income manager at Bryn Mawr Trust, it was clear that she would have multiple options and many suitors. I reached out to Mary and discussed that I felt, given our systems and our experience, if we collaborated, we could do better together. I stressed our excellent track record, our unblemished regulatory compliance record, extensive computer and analytical systems. Plus, we were pretty close to our home, had lunch brought in daily, and provided a health club membership. Something struck home with Mary. She agreed to join us in May, bringing her experience and knowledge that can only be gathered over a 30-year period managing government, corporate, and municipal bonds. Mary Talbot.
Thank you, everybody, for coming. Welcome. I'm the new kid on the block by about 3 weeks. But it's been a great experience so far. Everybody has been just a quality team. Everybody's so knowledgeable. Everybody shares information. And what I really like is that they're looking out for the customer. That's the number one priority out there. So my presentation today is going to be a little bit different than used to. We're not really going to talk about numbers. Most people come to me and say, well, how do you figure out what you're doing? How do you decide which way the market's going to go? What's your insight to strategy? So what I'd like to do today is to invite every one of you to become traders with me and co-portfolio managers for the next 15 minutes or so. I want to give you some insight as to some of the things that I look at and why I look at them. The first 15, 20 minutes of my day are taken to look at some of the screens that you're going to see, and most of these are coming from Bloomberg. We're going to talk about what are the credit markets telling us about the economy and central bank policy effects in the long term. When we're looking at the credit markets, the one thing you always have to remember is the credit markets move on expectations. They don't move on reality necessarily. In the past 3 years, we've seen the 10-year Treasury at a yield of 163 or 136, I should say. It's gotten down that far, and above 3%. So the credit markets are not necessarily following what the central bank is mandating, but they will react to certain things. When we're looking at markets, we look at sovereign areas. We're talking about Brexit right now. Will, Britain exit? I don't think it will. We're talking about Greece. Greece is having, resurging debt problems. The credit markets have expected this. We didn't think that was going away. When we talk about credit, it usually refers to the corporate markets. Mortgages, something you have to be very aware of. New issue mortgages with lower coupons, if you're going to buy them. As rates rise, you're extending the duration or the length of time that it's going to take for those to pay off. So that's going to interrupt cash flows. We're looking at money markets. Money markets right now, if you have businesses, you may be concerned about, what's going on with money markets because there are new regulations coming out in October where if you're an institution, you have to be in a floating NAV if you're looking at a prime or municipal money market. Otherwise, you have to move to government money markets. Well, is there going to be enough supply? What happens to the municipal markets because there's $240 billion in municipal short-term debt that's bought into some of these funds. So the Senate Banking Committee just introduced some legislation to kind of reverse those new SEC rules. We're looking at preferreds, equities, commodities. You have to give consideration to geography. When we're looking at geography, is somebody in a flood zone? Wichita Falls, Texas is talking about water reuse, so down the toilet and out the spigot. I don't think we're going to buy anything there. Brownsville, Texas always gets hit by hurricanes, so we don't buy Brownsville, Texas either. So geography is a very important thing. You look at the economy of the areas, supply and demand, which affects prices and yield curves, security structures. We'll look at yield curves a little bit later. But what's going on to make sure the issuer is financially stable, what's going on with headlines. People react to headlines almost instantaneously. So this gives you an idea of, some of the things that we're trying to take into consideration when we're forecasting. The black screens you're going to see are coming right from Bloomberg. I want to make sure I'm sourcing correctly here. We think about how do sectors and economies relate to one another. We're looking at global things, U.S. things, investment grade and high yield sectors, how they relate to each other, emerging markets. We're looking at municipal debt markets, big part of our economy. How are local municipalities, schools, everybody funding themselves? There have been a lot of cash flows coming into municipal funds lately, so we have to be very aware of what's going on with that, what's going on with ratings. We don't look at ratings per se, but I am looking at underlying ratings. If there's something's insured and it's giving the illusion of a AA rating, what happens if that insurance company goes away? I've been asking that since 1985. So we kind of found that out in the last few years with all these insurance companies having problems. We're looking at structures, refundings, supply, maturities, and this page, as we click through them, will give me more information. Here's the trick. The trick and the big secret to what I do is find the pattern. If you can find the pattern, you can find the answer to what's likely to happen and where you should be investing. If we're looking at education just as one sector, you can see the solid line there says that, okay, there's more overall issuance in education. But as the education, higher learning, do we have people going back to school because they can't find jobs and they're re-educating themselves? Are we seeing education issuance because Pennsylvania can't pass the budget and the schools need a bridge loan? That was a bad one. Interest rates, have they gone down? Are we seeing more refundings? Are we seeing people actually taking on more debt? So these are little clues to what's going on in our economy. Corporate debt markets, very important. Corporate markets, the debt markets tie into the equity markets, and we're looking at how yields relate to one another, how different corporate names relate to one another. Utilities are generally rated single A, triple B, but it doesn't mean that they're a worse credit. It's the way their cash flows in. When you're collecting money from hundreds of thousands of clients in your PICO, rather than getting a steady cash flow because you're a municipality and the taxes are coming in at a certain time of year, your ratings are going to look a little different. A lot of these ratings are based on cash flow. And, we could have a triple B utility trading just the same as, John Deere. Both are very worthwhile investments. Next. Flight to quality. This is a big subject. You know, we ask ourselves, when is this happening? How do we identify when this is happening? This is actually a 10-year IBM and a 10-year Treasury. That's right, flip it backwards. Oh, geez, okay. You know, we're taking a look at our global headlines affecting this. And that middle bar in green shows the spread or the amount of yield between the 10-year IBM and a Treasury. And the closer it gets, my decision might be to buy the Treasury rather than the IBM. The wider it gets, the more advantageous that IBM is going to be to the client. You know, sometimes it's a matter of, has Meredith Whitney spoken? You know, so then we've got all the markets going in all sorts of directions. The bottom section is what we call a regression, and we try to figure out how well are these two things correlated to each other. And it just doesn't stop with corporates to treasuries. We look at municipal markets to corporate markets and different ratings, different names. So there is correlation here, but it's not a one-to-one exact correlation. So, you know, this will affect where we feel markets are going. The next one is default risk. You know, we're used to looking at credit reports from Moody's, S&P, Fitch. Those are probably the ones that you're all familiar with. However, Bloomberg now has an investment grade rating system and a high yield rating system. So you know what? We sit down, it's something new, we take a look at it. Is it going to help us? You know, Bloomberg tries to come up with what are other traders and portfolio managers looking at. So a lot of times when you're looking at displays from them, you'll see what other people are looking at. Now, I like to take the time to call traders at different places and have conversations, and I like to get out there and visit them, because when you're sitting down, you have a conversation, you can learn all sorts of things. So Bloomberg came out with their rating system, and I was on the phone in about 5 minutes. Currency influences what you're thinking about the economy and your trading. If Japan has negative interest rates, as you can see, you know, up here, we've got a number of different countries that we're looking at. But if Japan has negative interest rates, is the currency going to appreciate? So if the interest rate is negative 10 basis points, but you get 1% appreciation, you're net 90 basis points ahead. So those are things that we need to consider, and things that we look at when we're trying to decide where is our economy going? How do we improve our total return? Strength of the dollar. If the dollar is too strong, are we outsourcing? Are we exporting our inflation to other countries because we're purchasing more from them? We went through a period of reshoring a couple years ago where we were bringing manufacturing back onto our own shores. You know, how is the economy going to digest this? So relationships between the strength of the dollar are very important for where is trade going in the economy. Market speak. How is the market speaking to you? What do you see? This is a high yield index, double B securities. And on the far left, you can see that there's this big drop in rates for the index. So the question is, if high yield returns are dropping, why are they dropping? Are they dropping because there's less issuance in the high yield market? Are there more buyers? Because supply and demand has a lot to do with where rates are going. And I know the answer to this because I cheated, I looked it up. When we look at foreign flows into the United States, there's a tremendous number of foreign money centers coming into buy our high yield securities. Everybody's looking for yield, including people in the US. This is the important one. This is the story of relative value. Everything we do with strategy and portfolio management and trading on the fixed income side centers around relative value. Where are you going to find the best value? What has the history of the pattern been? And what's unique about this is these curves are what we call a bear flattener. They're indicating to us that the front end of the curve is going to come up, the back end of the curve is either going to stay the same or come down. So the difference between 2 years and 10 years is going to get smaller, given, a lack of advantage in going further out the curve to capture interest rate. So what do you do about it? And the curves on this chart, if you look in the 20-year area, the top curve is financials in 2015. The next curve down is munis in 2015. The third curve is financials in 2016. You can see there's not a big movement between the first and third one, going from top to bottom. The next one is, the fourth line down is municipals now. And there's a much bigger move in the municipal curves from the second one to the fourth one. The last two are the Treasury curve, and the Treasury curve obviously falling, but the municipal curve fell a lot more, which means yields went down, prices went up. So as a portfolio manager, it's my job to know that this is happening, anticipate that this could possibly happen by all the information that we've been looking at. And I would have been buying munis, which I was doing even in taxable accounts, because that's where the best total return is going to come in. So the idea is to take advantage of the more significant drop in yield, increase in price, and then capture that. So that's a return to your client. To quantify it, corporates moved about 50 basis points, treasuries moved about 60, and the municipal curve dropped about 75 basis points. So there is a definite advantage to the municipals in this particular instance, and that's been going on for several years now. On the credit markets, and I do have more slides. This is just the last one on the credit markets from Bloomberg here. This is what I look at every day. If you walk into my office, you're going to see this a lot. So as my co-traders, I'm going to yell over and I'm going to say, okay, where is gold trading? What does oil look like? Where's the 10-year move? And this gives me a quick snapshot of just about everything that's gone on that's truly significant in the fixed income markets. It gives me an idea of where the dollar has moved. We can see the JPY is the Japanese yen at 109. At the bottom gives me what the most recent economic numbers are. And anything that you click on here will give you all these wonderful graphs and history and all sorts of numbers that you can run. And that leads us into central bank policies and long-term ramifications. There are a lot of tools that the Federal Reserve uses. They're in the markets buying and selling securities to help move interest rates around, particularly long-term rates. They've got shorter-term things that they get involved in, repos and reverses. They're using all these tools because their two basic mandates are full employment, and it's questionable if we're there. We're talking about 5%, but is that really full employment? And price stability. Where is inflation moving? How do they control it? And they're a credit facility. They offer ease of liquidity through the discount window and targeting the Fed funds rate. They've got liquidity arrangements with foreign banks, and we're looking at, okay, which foreign banks are involved with us, who needs money. The big thing is Fed speak. When the Fed speaks, are we listening, and how intently are we listening? A couple years back, when the 10-year Treasury got to 3%, the Fed was very adamant about the fact that they were not going to start tapering back on securities purchases, that the yields were just too high. So the market reaction was to have yields come down. The problem is that we're experiencing right now, we keep hearing, well, the Fed's going to move, the Fed's going to move. We finally got a movement last December. Is the Fed going to move this year? Well, the futures market is telling us there's a 4% chance that it's going to move at the next meeting. If you talk about it too much, it now becomes a whisper, and the Fed starts to lose a little bit of credibility. They need to make a movement because they need to get a tool back in the toolbox. They're running out of tools. They need to have a higher interest rate on the short end in case they have to lower it. It doesn't make a huge market effect, but it signals what their intention is. Policy rates, we keep a look at policy rates all around the world. You can see there's, several negative rates that we've been running into. The dollar, which currencies are moving the dollar, very important component of what's going on in making our decision of, where can we effectively invest around the globe, or do we, keep everything centered at home? Let's see. International yields. These are always interesting. If you look at Greece, there's a lot of sevens going all the way across. And what that tells us is that Greece at 7% in 2 years is a very risky business. If Greece were 15% out in the 10-year area, I would say it's going to be risky for a very long time. But because it's still got a 7 handle on it, that means the market is sort of digesting what's going on with Greece, and it's not a big deal at this point. They understand there are problems. We've seen instances where Greece had, I think it was close to 14 or 15% in the 2-year area, and it was much lower longer out, which says the problem is more immediate. In the longer term, things should smooth out. Germany, obviously, great place for flight to quality. Germany, Switzerland, and obviously the United States. The United States is a very prominent part of flight to quality. Monetary velocity. Now, this is a tricky one. We like to see how many times is money moving through our economic system. Well, according to this chart, money's not moving very fast. It's not changing hands many times. It's not providing us with a multiplier. And a lot of the problem here, you have to ask yourself, if you don't have good circulation, just like you don't have good circulation in your legs, your economy's cramping. Things are stalling, and you have to look around at reasons why something might be stalling. Why is it a slow economy? When we look at rate hikes and unemployment, again, you can see, the Fed doesn't normally raise rates during this kind of period, but they do need a tool back in the box. We've got temporary unemployment moving up dramatically. You've got a lot of students coming out of college, and they're trying to find a full-time job. They're winding up with 1 or 2 part-time jobs. You've got a lot of people who are taking part-time jobs because they have to. There's a lot of economic reasons. So you're asking yourself, who's working? Are they working so they can spend money? Are they working so they can save money? Or are they working just to pay the bills this month? That's a very real reality. This much part-time employment is not necessarily a good thing. Some common themes when you talk to portfolio managers, traders, we're looking at the central banks, and we're looking at the economy and everything going on. Negative interest rates, this is a new concept. There's more countries saying, okay, well, let's look at this. Negative interest rates are supposed to encourage banks to lend that money out or go other places for sources of liquidity. But who can they lend to? If people are out there looking for jobs and they're not actually finding full-time jobs or what they need, the earnings that they need, are these safe loans? Too low, too long is not necessarily good. It discourages, people from spending money, and you have a lot of seniors who are on fixed incomes. Interest rates are not providing enough income for them. So you have to look at it in its totality. Just the same as too high, too long is not necessarily good. When people see rates are high, they're always waiting for where's the highest point before I can get in, and a lot of times they're missing an opportunity. Again, the expanding universe of negative yields. more countries involved with it. Negative rates are moving more money into the U.S. markets. Everybody's looking for yields, and that's keeping our yields depressed and, certainly not helping us move forward. And then, again, as I mentioned, with the government securities and the new money market rules, if the SEC rules hold, then a lot of these institutions will probably be moving their money into government money markets, because the government money markets can have a $1 NAV and not have to float. So, we're looking to see how much of a hiccup is there. Global leverage, since 2009, you can see that, we're picking up more leverage, not just in the US, but across the globe. How long will this last, and when does the next bubble occur? The only number on here, and you can look at these later because they're very interesting. This came right from the FDIC. There's a number here that tells us there's 6,182 FDIC insured institutions. And that's important because with all the different central bank policies, especially here in the United States, and all the regulations coming into place, it's very expensive for banks to operate themselves, financial institutions to operate themselves. They're not making the margins that they used to make. They're not able to pay for the regulations that, monitoring that they need to. So we're seeing a lot of M&As going on, and we're seeing fewer banks. Back in 1990, on the far right, there were 15,158 banks or financial institutions that were insured by FDIC. At the moment, again, there's 6,182. So if you were a regulator, wouldn't you want to monitor fewer banks? I mean, that's, and I'm sure they've had a lot to say about cutting things back. So what are the credit markets telling us about the economy? What it really gets down to, after I get done looking at all these wonderful things every day, the economy's not really out of the woods. I've never really been a proponent of the fact that we've come out of a recession. I question the fact, do we have a new definition of depression, or is this just a very extended recession that we're really trying to dig the hole out of? There's a lot of telltale signs, and some of you, your grandparents, I grew up with my grandparents, and they were talking about potluck dinners on Saturday night and playing cards. And you can see a shift in where people are spending money and how they're spending it, a lot more conservatively. In 2008, just looking at all of these screens and things happening and looking at economic numbers, I made a decision that we were going to treat the investments as depression economics. I continued to buy out in the 10 and 12-year area. Stayed neutral or long any benchmarks that I had to deal with. We were continuing to look at relative value. Munis were a lot cheaper. We have a lot of issues with municipalities and pension plans, and people concerned about when things were going to blow up, and a lot of that had to do with headlines. But if I was fine with the credit worthiness of the municipality, I was buying munis. Made perfect sense, and those have been the best performers over the past few years. The portfolios that I was managing over the past few years were 100 to 150 basis points above the benchmarks, and that was buying less triple Bs than were in the benchmarks and staying out of foreign securities and just adding a little bit of duration to the portfolios. So pretty much corporate America is kind of going nowhere fast. They've laid off people, they've introduced technology, they're kind of stalling on investing capital, and the credit markets are coming back and they're saying, where's the government spending? And this isn't a surprise because, when you look at the basic formula of GDP, it's the government spending that seems to be missing. And the Federal Reserve keeps repeating this message as well. We've heard many speeches from Bernanke and Yellen asking, sort of pushing for a little bit more spending. And I think that's really what we need. And that's kind of what it comes down to. So, we'll continue to look at names, we'll continue to look at sectors, we'll continue to look at how everything relates to each other and relative value and finding the pattern.
Mary, thank you. That was excellent. I think anybody that walked into this room with the view that trading bonds was kind of a sleepy utilitarian job now has somewhat of a different view. In 2011, I approached David Gong and asked him to consider joining our firm to oversee a portfolio that purchases high-growth companies in local currencies in developing countries, including China, India, Malaysia, Brazil, Poland, Peru, Turkey. David was and is one of the most experienced emerging markets money managers in the world. His credentials include having served as a compliance attorney for the Securities and Exchange Commission after graduating law school. Afterwards, he went back to business school at Stanford and graduated and was recruited by T. Rowe Price and worked as a domestic equity manager. T. Rowe Price was one of the companies that was early on the curve in recognizing what was going on in the emerging markets, opened an office in Hong Kong in which they collaborated with the British merchant banking firm Robert Fleming, and they asked David to go and oversee the Hong Kong office of Rowe Price Fleming, where he did for a good part of the 80s. Afterwards, David moved on to Singapore and worked for Ancar Limited and managed, which was a consortium of Asian banks. I told David when I approached him that I felt that Brad's AdStar system was finding great companies in his markets well before other institutional investors who relied mainly on sell-side research. He agreed to visit our firm, and after 6 months of testing, modeling, number crunching, we opened the new fund. Since that time, David has won numerous institutional money management awards, including the #1 manager from AI Hedge, Barclays Hedge, PSN Informa, and other large institutional databases. Given China's ever-growing influence on world markets, I thought it would be helpful to bring in David and offer his point of view as to what is going on in China, what the risks are, and what the potential for a spillover effect into the developed markets, primarily the United States, might be. David Gong.
I'm going to set a timer for this. Bill mentioned that the point of the format today is for the speakers to briefly touch upon subjects that really invite you to hopefully approach us when we break, and really I welcome any discussion you have on any of the points that I'll raise today, because I really prefer a one-on-one dialogue rather than kind of speaking to an audience. But thank you, Bill, for that introduction. Actually, in planning this, the actual topic was, I think that was sent to you, is what is really happening in emerging markets and China. Will they take the developed markets down? So in a sense, I was approaching this with trying to answer the question for you, China, is the sky falling? And I guess to jump to the conclusion that the sky is not falling, but let's touch upon some of the issues that have lent themselves to the tremendous amount of volatility in global markets and particularly emerging markets over the last 9 to 12 months. Now, there have been a number of factors that the financial press has identified for why markets, particularly emerging markets, have been behaving so badly. I'm going to touch upon a couple over the next 20 minutes, and hopefully that will lead to discussion, a deeper discussion into each of those. As I look at the reasons why people have been extremely concerned about global markets, number one is slower global growth. All through 2015, I've watched and I track economic forecasts for growth for 2015, 2016, 2017. And about every couple of months, the numbers notches down, a couple of basis points and so on. And usually the culprit is what is happening in China. So we will look into what is actually happening with growth in China. Other factors that are cited quite often is a very, very sharp decline in the price of oil. And as you know, the price of oil is, people look at that as being something that is critical to growth in emerging markets, because there are a lot of emerging markets that are primarily commodity producers, and in particular oil. But maybe they're missing that for every loser in that equation, there is a winner. So we'll look at that as well. Finally, I'd like to talk a bit about the sharp correction in the Chinese local stock market that occurred in June of last year, and then following that a couple of months later, a start of a round of devaluations in the Chinese currency that really spooked markets, spooked currencies, and I think has a lot to do with the volatility in the market. So let's first turn to economic growth. So as I said, in looking at kind of recent International Monetary Fund projections, they currently estimate global growth for 2015 at 3.1%, and that will increase slightly to 3.4% in 2016. Looking behind those numbers, if you look actually at the group of emerging markets and emerging economies, those are projected to increase 4% in 2015, 4.3% in 2016, and 4.7% in 2017. And even if you look into deeper in those numbers, in fact, India, China, and many parts of emerging Asia, those parts are still projected to grow at a pretty robust pace. But that's just looking kind of at the next couple of years. And what I wanted to show you in this chart here is, if you step back, if you really understand where is growth going to be happening in the world over the next 15 years, 30 years, and so on, it is really going to be coming from what we term as emerging markets. And you can see in particular the economies of China and India are really projected. And you can quibble on maybe what year this really happens, but it is, I think, without question, that China and India, on the growth rates, really their populations, that over the next 20 years, certainly China is going to surpass the United States, and then looking out another, into 2060, even India will have a larger share of global GDP than the United States. So again, the picture here is that there is slower growth next year, and for reasons which we'll go into, but indeed, if you're looking for growth in a portfolio, you really need a component of these companies, well-managed companies that operate in these markets. Now, and this chart also, this more or less again makes it underscores the same point that if you look back, in 1950, China and India, they had a very, very small portion of the global economy. Then looking at 2050, you'll see that China, India, Brazil, and so on, they become very, very large components of global growth. Now, probably as important as kind of getting a handle on what are growth projections for China, it's probably more important really for everybody to understand the nature of the engines of growth for China, how they've changed. And this chart really shows, I think, one of the more important changes that's occurring. China, even back in 2005, they are shifting their economy away from a manufacturing-driven economy to one that is more service-oriented. And that's actually, it has very, very important implications on their banking system, on their currency rate, and so on. But we'll dive into that deeper. But if you just take a look at that chart, you want to compare it to, for example, if China right now is, maybe one back, or maybe this will actually show it, but both of them do. So China right now, 48% of the economy is attributable to services. In the United States, it's 80%. In Canada, it's 70%. Even in India, it's 58%. But so that's really kind of, in a sense, as economies mature, you should see a shift away from manufacturing, because that will usually go to places where there are lower input costs. And so China recognizes that, and so they have been, over the last 10 years, been moving towards a service industry. Now, not only that, and again, probably very importantly to understand, is not only are they shifting away from manufacturing to services, but indeed they're actually shifting away from an investment-led growth strategy to consumption. And that's, again, that was announced in the latest 5-year plan of China. They've been embarking on it for 5 years, and that's really causing significant, I think, changes in the way that the Chinese leadership is moving their economy. Now, when you have an economy that for so many years was really more investment-based, they gave very little incentives for the Chinese population to actually spend. So even though I think they've been relatively successful in moving towards a service-based economy, the consumption story will take a little bit longer. And again, I see that the move to services actually is really an important piece of that strategy to move towards consumption. The service economies actually provide more jobs. Service industries are more labor intensive versus the manufacturing industry in China. So there's job creation. Also, service jobs in China will have there'll be a higher wage attached to service jobs. If you look at the big shift in China is from the rural to urban. So essentially, urban service wages are 4 times of rural wages. So again, that'll be an important piece of the consumption story. But finally, really for China to successfully move to consumption, they have to solve safety net issues. The Chinese are not really, historically, there's really been no pension plan for them, for most of the people, particularly nobody in the rural economy, certainly. And as well, there's a very somewhat, in the beginning, very inefficient healthcare net. The Chinese leadership is addressing both, so I actually am somewhat hopeful that with these pieces in place, that eventually they will be very successful in moving the economy to where consumption is the important driver. Again, very important. And really the reason why I'm hopeful of that is just the mathematics of the middle class. So I think we have some middle class, maybe this is just pure population, but the next slide, I think. So those of you who actually are repeat visitors here, we've talked about how important the middle class story is for growth in the emerging markets. I mean, right now, you have very, very large and growing middle class groups in China, India, and also what I consider the ASEAN 5, the Association of Southeast Asian Nations. And even right now, in fact, I have I think Credit Suisse recently published that for the first time, China's middle class of 109 million people exceeds the 92 million middle class Americans. So that was actually back in November. But I think really it's again, and this chart kind of underscores that. If you go out to 2030, 93% of the global middle class is going to be from the emerging markets. And why is that important? Because as people get into the middle class, that's usually when there are defined consumption trends on property and automobiles and travel and movies, and I mean just essentially that's the sweet spot for consumption. So even if near term people are a little bit worried about growth in 2016, 2017, really step back. The big picture is this part of the world, they're getting to the middle class. It will be by far the largest middle class in the world, and they will begin to consume. Now, I think I did mention how oil had been, essentially with the collapse of oil prices, kind of they peaked at $150 a couple of years ago, and now recently in January they fell below 30. that had very unsettling impact on investors who a lot of debt investors as well as equity investors in emerging markets, because there's this kind of association that when oil prices fall, so many of the emerging markets also are losers in that equation. And indeed, the big losers include countries like Nigeria, Iran, Russia, the Persian Gulf countries, Mexico, Venezuela, as well as Norway and Canada. But really, they're the losers. But there are some significant winners in that equation. And by far, the biggest winners are China and India. I mean, a fall of $50 a barrel from where they were before, even 50, now it's actually 100, but a $50 per barrel price drop really translates into hundreds of billions of dollars of savings for China and India. As you can see, China and India are very, very large consumers of oil. And it's really happened at an important time for both countries. You know, for China, even though we can definitely see their exports slowing, the fact that their oil bill has gone down so dramatically, it means that even with slower growth in exports, their trade balance is still growing. And that's really allowed the Chinese some breathing room to begin to really, to allow for this really slow transition from investment growth to consumption growth. And I mean, really, I think I mean, there's really no precedent for a country to actually make that kind of change quickly. So that kind of change from investment to consumption, it will take time. The Chinese leadership is patient. They know at all costs they really want to keep political tranquility, and so they know that that it's not going to be an easy process. But I can read the leadership as they're committed to that change. For India, it's also come at a very critical time, and maybe there's even a better story about India. And India is a country with, again, a very large oil appetite, kind of plagued by trade deficits and particularly fiscal deficits. And the oil dividend for India has really allowed them to keep inflation down, to actually have, somewhat attractive foreign reserve buildup, and it's really given this new Modi government the ability to focus on really the critical economic reforms that India has to go through if they're really going to continue on a growth path. And right now, India is likely to grow about 7.5% in the coming year. And again, a lot of that I really attribute to this oil dividend that's really allowed the Indian leadership to keep interest rates low and keep inflation contained. Another beneficiary of this oil dividend is actually Indonesia. So Indonesia, which historically was an energy exporter, more recently has really turned and they become an energy importer. And so lower oil prices really have allowed the Indonesian government to do away with very costly fuel subsidies that really had a very negative impact on their fiscal position. So with the oil dividend, their fiscal situation looks better, their external trade position looks better, and the Indonesian rupee is one of the stronger currencies so far this year. So on balance, I really think that obviously the oil exporting countries, they're probably breathing a little bit of relief with a slight rally in oil. But I think that our forecast is that there will not be a real sharp rebound in oil if it stays around here. I think that in a sense this stability will actually be a positive for the emerging markets. And as I look at China, what they did, they were heavy buyers of oil in December and January as prices really crashed. I think they doubled their strategic reserves. So it gives you a little bit more insight into how the Chinese look at the oil changes in oil prices and where they decided it was a good time to come in and build up their reserves. Finally, before turning to individual companies, I want to make a couple of comments on the Chinese stock market crash and the issue of currency devaluation. Because really, if you kind of stay up and watch CNBC or Bloomberg News, there's about every day someone's forecasting something really terrible happening in the world, kind of caused by the Chinese stock market and a massive devaluation at the level of the 1997 Asian financial crisis, which I think, look, everybody has to be concerned about the buildup of debt in China, but there's so many differences between 1997 and the Chinese situation. I discount greatly that eventuality. Now, as you know, the Chinese stock market had a significant crash in June and then August and even more recently this year. But you have to realize that essentially the Chinese market had appreciated about 159% before the fall. So in reality, I look at it as just a much needed correction in an overheated stock market. It's a market that, very unlike our market, is really dominated by retail investors. There are virtually no true institutional investors that exert some discipline on these kinds of sell-offs. And so you really had not a stock market, but really almost a gambling casino. And so, when things begin to move one way, they really move quickly. The important thing to remember is the average household holdings of Chinese equities from an average household is very low. So you really have literally a smaller number, but very, very large individuals that play the market. And so they own the market, they buy, they sell it. It has literally almost nothing to do with the real economy. So my message to you is that a fall in the Chinese stock market or a rise in the Chinese stock market is not reflective of what's really going on in the true underlying economy. Now, 2 months after the stock market crash, China happened to devalue their currency. And so a lot of people wanted to put these things together. Oh my gosh, Chinese stock market falling, is it because of something wrong with the economy? Well, look at the export numbers. They're declining. Is China going to devalue to boost their export sector? Again, if you go back to what I was telling, what I think about what's the change in the Chinese economic growth engines, they're moving away from exports. They're moving towards services. They're moving towards consumption. So I don't believe that the Chinese have any intention of really using their currency as a competitive weapon to really help their export trade industry. As indeed, because of the oil dividend, even with slowing exports, actually their trade gap is growing. The history is that kind of prior to about 2004, the United States just kept on banging on the Chinese that they were undervaluing their currency and they were being bad guys and they had to do something. So the Chinese, since about 2004, they more or less agreed to kind of stay pegged to the US dollar, which has led to about a 60% effective devaluation, overappreciation, of their currency versus actually their trade-weighted components. So they were losing ground to Europe, they were losing ground to the Japanese, they were losing ground to the Koreans, Thais, you name it. So I actually think that what happened is really now the Chinese have decided to move away from a peg to the US dollars to more in line and having their currency move from this point forward more to their trade-weighted basket. Not only that, the Chinese really want to see the renminbi eventually be freely convertible. They really want it to be a reserve currency in the world. They need to bring stability to that, and part of that will be a very gradual devaluation in the currency. So again, I don't think that the Chinese leadership has any intention of using devaluation to boost their trade. I think if they want to be part of essentially the foreign reserve currencies and part of the IMF reserve, special drawing right reserve, they need to behave very responsible as they manage their currency. And I see nothing wrong for them to really peg that basket to their trading partners versus the United States. But lastly, as I had mentioned before, because of the buildup in debt and because of these devaluations, There's some very well-known hedge fund managers in the countries that have been very public about they're examining the debt buildup, and their conclusion is that indeed China will have to have a large-scale devaluation, really to kind of pull the Chinese out of this low growth scenario. And the Chinese are still forecasting their growth to be about 6% this year, 6% the next year. And although indeed, it's there are a lot of critics about economic numbers coming out of China, I kind of believe that everybody should be looking at these macro numbers out of any country and having questions about them. It's as economies change, as we go from old manufacturing or agricultural statistics to modern economies with a lot of very difficult to track and understand growth rates in services and the internet economy. I think that the criticism of Chinese growth numbers are exaggerated. I would say that you're probably plus 1% plus minus on any kind of given broad number, but put that in perspective. That means I really do believe that China grows something like 5%. But even that masks something that's more important, that China, with that $1 trillion economy, is made up of many $1 trillion industrial sectors, or economic sectors. Some of those are growing very, very rapidly. As we look at things like the internet economy in China is growing very rapidly. Retail sales are actually growing much faster than stated GDP. Entertainment. So you have a lot of the new economies of China that are larger than many countries growing very rapidly, and companies engaged in those parts of the economy are doing very well. The sectors that are more cyclical. If you're involved in mining coal or fabricating steel, you're in a recession, you're in a depression. And even though companies involved in those activities, because they're deep cyclicals, we're seeing now that really across the globe, the deep cyclicals are beginning to catch up. So far this year, it's really been away from growth into cyclicals. So that's kind of a signal where the mentality is right now. But in China, really, if our mission is to find growth companies, we still find plenty of growth companies, but they're serving the consumers. The Chinese automobile industry is the largest in the world right now. I think they manufactured 24 million cars this year. Much more than the United States. And you really think back, back in the early 90s, there might have been 4,000 automobiles in the entire country, to now where they're selling 24 million. That's the power of a consumer segment that really is growing. And so as we look at China, just really realize that it's such a big, diversified economy. It gives it strengths that I think allow it to be resilient to kind of the pressures that some of these the hedge fund managers are pointing why they think there'll be a 1997 event. In general, Asia and China, you're looking at much better foreign reserves kind of across the region than I saw in 1997. You see much more diversified economies, and you see much stronger banking systems in most countries with much higher capital adequacy levels. That doesn't mean China's out of the woods. Clearly, I am concerned about the buildup in debt. China will likely have to figure out how to basically deal with all of the bad debt in the economy, but I don't expect, they won't do a 1 year, let's clean out the stables and have a one-time shock. The Chinese leadership doesn't act that way. It's more likely that they will. It'll kind of look a little bit like Japan, but it's still a command economy. So they will figure out a way to eventually recognize these losses at a measured pace and grow the economy at the same time, because the Chinese leadership will be playing a 20 or 50-year game rather than a 1 or 2 year game. That's my timer, and I'm done. So, again, I invite anybody really to, if anything I've said kind of sparks a question, I'll be around all evening. I really would love to meet each and every one of you and really talk about anything that I've raised today. Thank you.
Okay, thank you, David. Our next speaker, Brad, joined our firm in 2004, and within a relatively short period of time, he changed the way we gathered information, selected, valued, bought and sold stocks and other investment instruments in our portfolio. With a degree in computer science from one of the top schools in the country, he could be and probably should have been working for Google, Amazon, Uber, or Facebook with his other classmates. Instead, he decided to apply his skills to the investment business and is now recognized as one of the top managers in the industry by multiple institutional tracking services that follow and compare. His AdStar system, which he has designed from the ground up and wrote, has put us in the global stage and allows us now to recruit veteran first-class managers like David and Mary and blend their experience with his digital age. In 2016, we named Brad our CIO, and however, it's highly unlikely you'll see Brad on Bloomberg or TV self-promoting. Instead, he can be found in his office in front of 2 computer screens watching over your money. Today, Brad will discuss his approach to generating a positive return in volatile and challenging markets.
Thank you, Bill. Good afternoon. Well, before I begin, I want to compliment David and Mary on 2 very insightful presentations. We did not do a dress rehearsal this year, so that was the first time I heard it, so job well done. Okay, long-short investing in volatile markets. First, let me explain the terms long, short, and long-short. To go long simply means you buy a stock. Effectively, you're betting on the company. To go short is a bet against a company. The mechanics can be a bit confusing. You borrow shares to sell in the open market, and you immediately book a liability for your obligation to buy those shares in the future and return them to the original owner. But for the purposes of this presentation, think of it in terms of long positions gain if a stock goes up and shorts gain if a stock falls, and vice versa. There are 3 basic types of fund strategies: long only, short only, and long short. Long short funds are the most dynamic and traditionally entail portfolio managers making pair trades, which are bets that a particular company will underperform one of its competitors. In addition, these funds have the flexibility to alter their long and short exposures based on where they think the market is headed. Today, my focus is on long-short investing and why today's market is an ideal environment for this kind of strategy. I'm sure most of you have read or heard headlines regarding the problems with the global economy and that stocks are headed into a bear market. To that end, I will tell you that we almost always ignore this type of news flow because it tends to be sensationalized media that lacks any real factual basis. A quote that I live by in the financial world is that information is cheap, but insight is priceless. We are inundated on a daily basis with a barrage of articles that are purposefully polarizing and mostly useless. So for this reason, one of the most critical skills in this industry is the ability to discern between noise, as we refer to it, and information that is of real value and can be acted on to generate profit. In this slide, I offer a few headlines that didn't immediately go to my recycle bin. All of these are from within the past month, so they constitute live advice. Most of you are familiar with Carl Icahn, the billionaire investor who takes large activist stakes in companies. His investments have historically always been very heavily weighted to the long side, except for today, which is why this caught my eye. Icahn said last month that a quote-unquote day of reckoning is near for stocks. He liquidated his entire stake in Apple, which had been over $6 billion, and he has now built a 150% net short position, which is an enormous directional bet against the U.S. stock market. To give this context, it means that with approximately $30 billion in assets under management, if you take the total value of all his shorts and subtract out the total value of all his long positions, you end up with a $45 billion bet against stocks. So his conviction that the stock market is on the cusp of a major meltdown is high enough that he's willing to use leverage to make 50% more in short bets than the $30 billion that he has already to work with. Fewer of you may be familiar with Stanley Druckenmiller, but his name carries no less weight in the institutional investment world. He is one of the most famous disciples of George Soros, ran arguably the greatest hedge fund in history, and was so successful that he retired and voluntarily returned his clients' capital in 2010 after successfully navigating the 2008 subprime crisis. He also almost bought the Pittsburgh Steelers, donated nearly $1 billion to charity in a single calendar year, and now he simply manages his own money. When asked for a specific recommendation at a recent high-profile hedge fund conference, he simply said, but with absolute conviction, get out of the stock market. And we can actually, as of yesterday, add George Soros himself to this list, as it was reported yesterday that he reduced his equity holdings by 35% in the first quarter, which is a large move for him, and started buying gold. While we definitely share some of Icahn and Druckenmiller's views, we have always and will always build our outlook and form our opinion internally from the ground up with real data and hard evidence. Specifically, we do agree with them and others in their camp that, number one, the effectiveness of central bank policy is diminishing. Two, economic growth is both anemic and decelerating. Three, there is a growing risk that we will at some point in time see a corporate credit crisis. And four, that U.S. stock markets are overvalued. While we do agree with them on these points, we disagree that a significant crisis is imminent. The reason is simply that the U.S. Federal Reserve and other central banks across the globe are not yet out of ammunition, and they are absolutely still committed to avoiding any type of recession at all costs. This was on full display earlier this year when global markets were entering free fall and central banks responded with more quantitative easing, more stimulus, actually buying stocks in the case of Japan, and now negative interest rates. And in the case of Japan, their central bank is the largest shareholder in their public equity markets, owning approximately 10% of stocks. We believe that so long as central banks still have powder in their kegs, which by the way are not infinite and will eventually be empty, but as long as they still have dry powder, they will provide a backstop to equity markets. And this essentially creates a floor for stock prices at levels where they will become concerned and take action. At the same time, it is also very, very clear, no matter what data you're looking at, that their ability to do this is wearing out and their credibility is receding. And make no mistake about this, they are in the credibility business. It doesn't matter what actions they take. If the markets lose confidence in them, they become instantly powerless. The enormous problem that they face is while their actions were incredibly successful in preventing another Great Depression, they have failed miserably in creating an economy that is anywhere near able to support itself without stimulus or ultra-loose monetary policy, a state that Ben Bernanke described as escape velocity. The patient has been on the medicine for so long that he is now addicted and will go into withdrawal without it. And so we are getting further and further away from escape velocity, not closer. But according to the Fed, the U.S. economy is just a few quarters away from escape velocity, except the problem is the Fed has been saying this for the last 4 years, and it has failed to come to fruition. In fact, the economy in almost every single aspect is decelerating and getting closer and closer to stalling out. It is now more dependent on stimulus than ever, and this makes the Fed's job of engineering a smooth return to normal policy very unlikely, and actually almost to the point of impossibility. We talked about the Fed's backstop creating a floor for stock prices. Well, on the flip side, the central bank's growing impotence, along with very, very elevated global debt levels, puts a synthetic ceiling on markets. And so what we are left with, we believe, is this band that stocks will likely trade in and bounce around for the foreseeable future until we reach what I call the end game, which will involve one of two scenarios, and I'll talk about this later on. So instead of the big crash that Icahn and Druckenmiller are anticipating, our base case scenario is for ping pong markets, with periodic 5 to 15% sell-offs followed by relief rallies. similar to what we've seen in the past months and last summer. This will go on and on while continuing to more or less confuse the hell out of most investors until central banks fully empty their chambers, and this will be their last desperate measure to attempt to inflate asset prices and resurrect the economy, but it will likely fail. And so we do expect that a crash will happen, just not for another few years, but when it does end, it will not end well. Okay, so let's go back to long-short investing and navigating ping-pong markets. We have traditionally been long-only investors, avoid market timing, and try to be as pragmatic and open-minded as possible. What we generally do is devote the majority of our time to doing analysis in order to identify and invest in great companies. The problem is that recently we have been having a tremendously difficult time finding well-run quality businesses that trade at reasonable or even slightly overvalued prices. The number of opportunities that we are finding is alarmingly low and easily lower than any time over the past 2 decades. What we are finding instead falls into 2 main categories. One is highly leveraged cyclical companies that trade at what look to be low multiples, but in reality are much too high and don't provide enough of a buffer against profit declines. And this is critical when you're investing in these types of companies, because when a recession comes, their earnings can easily fall 50% or more. And when that happens, their low, seemingly attractive multiple can double or even go negative and get ugly very, very quickly. These stocks are trading in the 3% dividend yield range, which is enticing for a stable defensive company like a utility or big pharma, but not for a cyclical. These stocks really need to be trading in the 5% plus dividend yield range to provide a large enough safety net. There are a few stocks out there that are trading in this with these very high dividends. The problem is that most of them are very, very over leveraged and at high risk of default or a dividend cut. Over in the second camp, and in my opinion just as scary, we are finding tons of very low growth, very overvalued, sluggish companies like a Johnson & Johnson that are trading at valuations that, in our opinion, should only be paid for the likes of Facebook or Amazon. Unfortunately, as you might imagine, companies that are experiencing high growth right now, which are fewer and far between these days, are trading in a different stratosphere altogether. Well, let's look at some of the actual data. This chart is pretty self-explanatory. It's not very pretty. Why do we look at nominal GDP instead of real? Well, companies don't report inflation-adjusted sales growth. They just report sales growth. And the impact of inflation is different and not necessarily bad for all companies. Some firms with strong products and brand recognition are able to pass through rising costs to their customers, while other companies can suffer immensely from even a small increase in their input costs. But real GDP does give us a strong sense of sort of the general quality of economic growth, so we'll go back to real. Growth was almost non-existent in the first quarter of this year, 0.5%. Optimists will tell you that this is simply due to seasonality, as Q1 is usually the weakest quarter of the year, which does tend to be true, but estimates for this quarter are not much better and are being revised down on a weekly basis. Why does this matter? Well, as I alluded to, there is a strong link between nominal GDP and corporate sales. Sales growth has been very, very poor the last few years, and since companies cannot create their own demand, what they focused on is what they could control, and that's namely cost cutting. This is one of the main tricks that allowed them to generate earnings growth on flat or actually declining sales. They squeezed costs hard and got very lean and very efficient. The problem is that they can only do that, they can only cut weight for so long until they begin to lose muscle. And the process of doing so has both sapped global appetite and sacrificed their future demand. Another tool that companies have used is to issue debt and buy back their own stock. Debt financed share repurchases in order to increase their per share metrics. Pfizer is a very good example of this, but it's just one of many that have been doing it. This chart is a bit busy. It's somewhat difficult to read, but I'll try to simplify it. The solid blue and solid red bars are what actual sales and actual earnings growth were for Pfizer these past 5 years. The checkered boxes represent the per share figures. So what you see is that sales have been down all 5 of the last 5 years for Pfizer. Kind of surprising. Their sales have fallen every year. But their sales per share has actually increased in 3 of the years, and earnings per share has increased in 4 of those years. The problem is that this is absolutely a game of diminishing returns, which is clear from the downward trend in growth, as well as the decreasing boost from the buybacks. And on top of that, any company's balance sheet can only support so much debt. Unfortunately, today, many large corporations are getting near those levels. This table depicts EPS growth, debt levels, and the forward PE ratio for some of the largest and well-known U.S. companies. And just so you know, when a firm's debt-to-capital ratio breaches 100, that means they have more debt than total assets, i.e. negative shareholders' equity or book value. Some companies are able to operate in this state, and they can do so in a stable manner, but there are very, very few of them. Not many banks want to lend to a company that owes more than its underlying collateral is worth. So the median the median earnings growth rate over the past 5 years, and this is per share, so it includes that boost from stock buybacks, is 1.8%. And the median forward price to earnings ratio, based on the expectations for this year's earnings, which are pretty optimistic in my opinion, is 22. 22. Make no mistake, this is very expensive. In fact, what it means, in our opinion, is that we are much, much closer to a bubble in the U.S. stock market than we are to a normal market. The United States has been, unequivocally, has been in an industrial recession for almost a full year, and conditions are getting worse, not better. Okay, yes, but it is no secret that we have been, as David mentioned, 88% a service-based economy for several decades, and that manufacturing plays a much smaller role than it used to. This is very true, but there is still a problem. Retail sales, which has been the last beacon of hope for our economy surviving in a post-stimulus world, retail sales are rolling over, and it looks clear that growth is actually headed to negative territory. Several major retailers, including Macy's, Costco, and Nordstrom's, recently within the past week slashed their year-end sales targets and abandoned giving forward guidance altogether because they have no visibility. This is very uncommon. It's not at all normal, and I think it is a fairly ominous sign. As of this morning, you can add Home Depot to this list. They've been one of the best growth stocks in the recent years. Reported a sharp slowdown in sales growth and comparable same-store sales. So, okay, given all of that, what do we do? What is an appropriate strategy? Well, first, I believe that you absolutely have to be fully hedged at all times to protect against a major market correction or the day of reckoning that ICON is waging $45 billion on. The end game for central banks will ultimately come. We think it has a low probability of occurring in the near term, but that said, it is still a very real risk at any given moment, and any number of potential external shocks or global geopolitical events can quickly trigger fear and panic in the markets, so stay hedged. Second, after big sell-offs in the market, such as that we saw in January and early February, sift through the wreckage, find the gems, ignore the negative headlines, look for overly beaten down companies, and build new long positions. Then, as the Fed steps in or markets simply realize that a recession isn't quite yet upon us, gradually begin to pare back and reduce those positions during what we in the industry call relief rallies and sell into strength. Lastly, do not take large bets and avoid getting either overly optimistic or overly pessimistic. That is until the end game. And I told you earlier that I would explain what I mean by end game. Well, what we expect is that one of two things will eventually happen, and it could take a few years. One, and we believe less likely, either the U.S. economy shows consistent signs of accelerating and finally achieves what Ben Bernanke called escape velocity, or two, and more likely, the Fed and global central banks run out of ammo and lose credibility in the faith of the markets. Then what you do is you stay on the sidelines while that 5 to 10% correction that previously had reverted, and you've been playing in those ping pong markets, and you wait while this 5 to 10% correction evolves into a somewhat nasty and long-lasting bear market. But until then, safe investing to all. So that is it. That concludes our presentation for today. and I'll invite Bill Stanley to come back up here for closing remarks.
I'm pretty sure this is a slide that most people have been waiting for. But yes, thank you for your attention. Again, all speakers will be here. They invite your any questions. I think if you go through the back door that Anthony Bruno, one of our portfolio managers, is stationed at right now. There'll be cocktails and dinner for anybody who cares to join us. Thank you.